Randy, thank you very much for joining us today. How are things in Vancouver?
Fantastic, Jimmy. Thank you for having me again.
The pleasure is all mine. Randy, before we do the deep dive on silver and gold, I want to first provide some background to investors who might not be familiar with the royalty and streaming models. And Wheaton Precious Metals is not a mining company, but a financing company that provides financial solutions to mining companies. And it does this through streaming agreements. And before we begin our discussion, why don't you just tell us what a streaming agreement is and how it's different from a royalty agreement?
Sure. A streaming agreement is a contractual partnership between an operator or an operating joint venture group or whatever and the streaming company. And we supply capital up front. And for that capital, we get a share of the metal production. And typically, what we'll focus on is a non-core byproduct. So, from a copper mine, we'll take the gold production that comes from that copper mine, or we'll take silver from a lead zinc mine. We do also do gold streams on gold mines and silver streams on silver mines. There's not a lot of silver mines out there, but yeah, and so we're focused. It allows us to focus specifically on that byproduct, that precious metals byproduct. And when that metal is delivered to us, we make a production payment, and that is fixed and agreed to by the contract. And so it's not subject to inflation, and it's predictable. It's a fixed cost and very healthy margins. And so currently we're operating at over 80% operating margins with our current production. And it's a great way of investing into the precious metals space, especially because it's such a low risk option. It takes the cost risk out of the investing decision in the precious metal space.
And maybe you can just expand on some of the risks or some of the benefits associated with investing in a streaming company like Wheaton as opposed to investing in a mining or producer.
Well, the biggest challenge that mining companies have is when commodity prices climb, lower grade material becomes more economic, and it works its way into the processing stream at these mine sites. And when that lower grade material gets processed, it automatically drives up costs on a per ounce or a per pound basis, depending what your product is. Is it precious metals or base metals? But it always will drive up costs. And so that's one of the challenges that you have, is that costs will chase commodity price in a mining company. But when you have a streaming company, our costs are fixed. They're defined by the contract. And so there's no surprises. And as I said, we don't get any inflationary pressure or even cost pressure this way. Those ounces we pay the same on a per ounce basis, whether it comes from low grade material or high grade material. So that confidence is what makes us so attractive to investors.
And if the miners at a mining company go on strike, that doesn't impact you. Or if a mining company engages in excessive exploration that leads to a lot of additional ounces, you don't have to put up one penny for that.
That's exactly right. If they do go on strike, I mean, we get a share of the production. And so if the mine actually shuts down because of a strike, then we have to wait, like the operator has to wait for that to get resolved and move forward. One of the things that we've been really successful with at Wheaton is selecting high margin, high quality mines. And what that means is that not only are we profitable at these mines, but our operating partners are also very profitable. And what that does is provides a lot of incentive to make sure that any labor disruptions or anything that disrupts production, there's a lot of incentive to get that fixed and get the mine back up and running and generating, again, good, strong revenues for all the stakeholders, including the streaming company.
And one of the benefits that I really enjoy about royalty and streaming companies is this leverage to the gold and silver price. And even though stocks and bonds have been under pressure here in recent weeks, the price of gold is up 20% on the year, silver's up 10% on the year, Wheaton is up significantly more than that. Maybe you can just touch on the powers of leverage.
Well, and in fact, that's an advantage that streams have over royalties, is that we actually have a production payment on a per ounce basis. And so we have leverage on that commodity price just by virtue of that fixed cost payment that we make on a per ounce basis going forward. So it actually generates even better value than a royalty does in the space. And really that's what it comes down to, is the fact that when if precious metal prices went up by 50%, our cash flows would climb by about 60, 65. We are a high margin business, but we still do get that leverage. And so our cash flows would climb by over 60%. And it does position us very well for taking advantage of that. But again, because we don't have the cost pressure that comes from the mining companies, what we know is that our cost on a per ounce basis is confident. And so we're not going to lose it to cost increases.
And Randy, many people might not know this, but Wheaton Precious Metals was once known as Silver Wheaton because you were just focused on silver, but now you're focused on both gold and silver. Why did you make the transition to both metals?
Well, the challenge that we were having in the silver space is that there's just not enough opportunities to invest into it. It's such a small market to begin with, but secondly, there's just not a lot of mines, new mines coming on. Typically, when we supply capital, it's to fund construction and development of new mines, and we just didn't see enough capacity in the silver space to satisfy it. So, about probably 12, 13 years ago, we started looking at gold at the same time, and just by virtue of the larger gold market compared to silver, we're now a dominant gold company. 60% of our revenues comes from gold, about close to 40% comes from silver. And so gold is definitely, and when I look at the opportunity set we have in front of us, it's heavily biased towards gold. There's a lot more gold opportunities out there than there is silver. That being said, I'm still a big silver bull. If I was going to pick a favorite metal, it's always been silver over gold.
So let's talk about that now. I want to ask you about the silver price because gold is trading at or near all-time highs, but silver is nowhere near its all-time high, $50 that we saw back in 2011. I can't believe it was that long ago. But even when you look at the gold-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, it's currently trading around 100 times versus 30 times back in 2011. And I also hear many bullish comments about silver production, how production keeps declining every year. It's around 800 million ounces, but yet the demand for silver keeps climbing at around 1.2 billion ounces. Why is silver lagging behind the gold price?
Well, silver has always lagged behind the gold price, and it's a bit unique. It depends on what drives the gold price to begin with, right? Because silver, it generally only gets treated as a precious metal by the retail market. It's the retail investors that come into that space, and to be honest, this gold bull run that we've seen in gold prices over the last 4 or 5 years, and really over the last couple of years. It started at central banks. It was central banks around the world, specifically in the eastern part of the world, in Asia, China, obviously, Southeast Asia, the Middle East, and even parts of Eastern Europe. Central banks were the first step of driving up gold, starting this run on gold prices because they started shifting away from US dollar and into gold. And they are not chasing silver. It's been a long time since we've seen central banks investing into silver, and none of those banks were interested in the silver side. So there wasn't support for the silver, but this was clearly evidenced by the fact that even though gold prices were going up, ETF holdings in the gold space were dropping. And if ETF is a really good reflection of retail demand. And so even up until about 5, 6 months ago, ETFs were dropping even in the gold space. What we have seen over the last, 4 or 5 months is gold ETF holdings climbing. And that tells me that we're starting to wake up the retail side, but it hasn't fully waken up. And it always takes place first in gold. You go back and look over the last 50, 60 years, every time gold goes for a run, silver will lag and then it will outperform. And so I do think that we're not quite to that point yet. We haven't seen a total awakening up on the retail side of gold, but I can tell you there sure is a growing appetite for it in today's world. Silver should follow shortly, after that as we move forward. The fundamentals are very strong there, so I wouldn't expect anything different this time around.
And you touched on this earlier, but 75% of all silver is produced as a byproduct, and lead zinc mines are a big producer of silver. And have you been involved in any silver deals in recent years?
Well, we've got a couple of streams this year where we're going to be getting silver from. We get some byproduct silver from Artemis at the Blackwater project here in BC. We have Mineral Park starting up production in September of this year down in Arizona. It's a copper moly mine that also has silver byproducts, so we'll be getting some silver from there. We've got some good silver growth. Antamina, which is one of our flagship assets, should be increasing its silver production dramatically over the next 2, 3 years as they move into a higher grade portion of the ore body. So we should see a 30 to 40, maybe even as high as 50% increase in silver productions there. So, I mean, we are seeing some growth in the silver space, but, the challenge is, as I mentioned earlier, is that most silver is produced as a byproduct from mainly lead zinc mines, even a bit from copper mines. And we're just not seeing a lot of investment. The prices just haven't been high enough to justify any substantive investment into those commodities. And so if they're not getting built, we can't, invest into them. We have to there has to be enough of a shift in demand for copper and lead and zinc to start pushing the silver production from there.
So if copper is trading somewhere between $4 to $5 a pound, where do you see it going, or where does it have to go in order to see mines being built?
Oh, I think you need to see something up well over five, if not over $6 a pound, before you start seeing. And it needs stability there. It can't just shoot up there and then come back down. I think everyone, investors, the mining companies, the ones that have the assets, but, the biggest challenge with some of these base metal projects is they're very, very capital intensive. It's not $1 billion. It's multiples billions of dollars, maybe up as high as $10 billion for some of the larger projects out there. And so those are huge capital commitments that are going to take, 3 to 4 to 5 years to get built before you actually start seeing any cash flow from that. So you have to have some confidence in terms of the long-term price projections. And it does look good, especially for copper, especially, with the drive towards electrifying the world. But we just haven't seen it in price yet. And without the price, nobody's going to make the commitment.
I want to move on now and discuss your balance sheet and capital allocation. And because of these high gold and silver prices, you're spinning off a lot of free cash flow. Maybe you can speak to that, how much you are producing and how you're going to allocate that in the coming year.
Well, this year we should be producing somewhere between 600 to 670,000 gold equivalent ounces. We've got four mines that are starting up production this year, so it's a pretty broad range. But if we get Artemis is actually doing relatively well on their startup, and we've got, as I said, three more mines that'll be starting up over the course of the year here. So Goose with B2 Gold is sometime in June. Mineral Park is in September, and sometime in Q4 we're going to start seeing our first production from Flat Reef. So, but that's 635,000, center point on the 600 to 670. That at current prices and with our low cash cost on a per ounce basis will generate about 1.5, maybe even a little bit more than that at these prices, billion dollars of free cash flow. We do have a pretty healthy dividend. We have a policy of trying to lead the pack in terms of returning as much capital as we can to our shareholders, a higher percentage of our revenue on a per ounce basis to our shareholders than any other company in the precious metal space. So we'll always focus on a progressive dividend that keeps us at the top of the group from that. So there is some money that goes back to dividend, but the rest of it, we're busy trying to look for new projects and put it back into the ground and grow the company by looking for high quality assets through additional streams. And as I mentioned earlier on, we're not seeing investment into the precious or into the base metal space, the copper and the lead zinc miners, in order to try and get the byproduct gold and silver from them. But what we are seeing with these high gold prices is a lot of activity in the gold space. And so I'm comfortable that we'll be able to put some more money to work this year, and continue to fund this. We've already got such a strong growth profile. That 1.5 billion this year, if prices stayed flat, that'll be up over or very close to 2 billion. I think it's 1.9 billion by 2029. So it's really exciting times. We've made a lot of investments over the last 4 or 5 years, and they're finally going to start delivering their rewards over the next 3 or 4 years.
And Randy, does this high gold price help or hinder your ability to find good deals?
Well, it definitely drives activity. With prices like this, everyone wants to build their gold mine, right? And they're moving forward. The biggest challenge is, and it's always been a challenge that that we're happy to look at, is focusing on the quality assets. We're always looking for the assets that have the highest operating margins. Again, if there's any challenges at the mine from a production perspective, if there's labor unrest or anything like that, if it's a high margin mine for the operators themselves, they're going to put their best focus on ensuring that mine gets back up and running and get the issues resolved as soon as possible. And so it just helps if you've got aligned interests, and if it's delivering high margins to both the operator and to Wheaton, it's the best kind of a structure to have.
And Randy, you and your team are always on the road meeting with investors, and you were recently in Asia and also Australia. And I'm curious, what sort of questions or comments are you hearing from these investors? And are these what you would call gold-focused investors, or are they generalists?
No, we're actually starting to see quite a few more generalists. And in fact, the number of new conferences that I've been invited to over the last 6 months has dramatically increased. And these are big, big conferences that are just basically, institutional investor conferences, but they just don't have resource. They haven't had a resource presence for a long time. And all of a sudden now we're getting invited as the gold representative because there's an interest, there's an appetite, a growing interest and appetite for gold. And so even at some of the stalwart conferences that we've been to of late, a dramatic increase in new faces and new funds coming in to have a look at it. So there's absolutely no doubt there's a growing interest in terms of precious metals, and I think it's just getting in more intense. And this last trip that I did over to through it was a 2 week trip, 1 week in Asia and a good chunk of a week down in Australia. A lot of new faces. And a very healthy appetite. Again, the fact that we have such a lower risk profile than your traditional mining company, and yet we still provide the upside, the leverage, and we provide a dividend. Wheaton is looking like the best way to dip your toe in the water and come into the precious metal space because we do such a good job of limiting the risk, and yet we still deliver all the upside, the exploration potential. These are all life of mine streams, and so as these mines run, we continue to receive our share of the metal from these mines, and so the exploration expansion potential and the commodity price exposure. It's something that resonates as a way for people to come into the precious metal space, and so we've had a healthy appetite of investor interest.
And when you're meeting with these investors, what are some of the common questions that come up?
Well, I think our growth profile really stands out. Again, the fact that we've got 60% over the next 7 years or 40% over the next 5 years, and then still another jump up after that. And so one of the first questions they'll have is just what are the risk factors within that? And what's nice about that growth profile is it's coming from about 10 or 12 different mines that are going to be adding to our portfolio. As you know, last year we had 18 mines feeding us metal. By 2031, we'll probably have I think over 30 mines delivering us metal. We have 4 new ones coming on this year, 2 next year, 2 the year after, and so lots of growth on that front. And so everyone wants to understand and get comfort with the low risk profile that we have there, especially because it's diversified across so many different assets. We're really comfortable with that. But I think the second thing that they're curious about is silver. We are getting a lot more questions on silver. And given that our company is the size of a scale, we are probably one of the best and easily most profitable ways to invest into silver. To be honest, most of the silver companies that you hear nowadays, they're dominantly gold companies that have a bit of silver byproduct production. They still have silver in their name, but from a silver torque perspective, Wheaton still provides probably one of the best exposures, and so that whole combination of the growth and the silver torque is something that's really catching investors' interest.
Randy, as we wrap up, many investors are trying to make sense of this current economic environment. There is a lot of volatility out there, and stocks and bonds have been really under pressure. Gold and silver are hanging in relatively well. Wheaton Precious is doing relatively well also. But what would you say to investors who aren't in gold and silver yet, or might not be involved in a stock like Wheaton Precious Metals? Is it too late to get in?
No, I don't think it is. I mean, I really do think you have to ask yourself the question, where does the strength come from that's going to support a strong US dollar? Because that's really, to me, the aspect, the fact that makes me so bullish about precious metals is that the debt levels and the debt servicing levels and the challenges of managing it. And now what you've got because of tariffs is a whole bunch of countries around the world, a lot of which hold US debt that aren't all that interested in being supportive, and so I think it's the current environment, and we're going to see this for at least 3.5 more years. I think it's set up very well for what I call a comfort metal. That's what gold is. Gold and precious metals itself is a great way to store value in times of turmoil, and that I think fits current times pretty well. The amount of up, down, the volatility that we're seeing in areas that are typically and traditionally relatively stable. That's the advantage of precious metals, and so Gold is by far the more stable, just by virtue of its size and scale of its market, but silver definitely adds a nice touch of torque to the precious metal space. So the combination is a great package to have. Everyone should have some gold in their portfolio. And I think Wheaton is a good foundation investment in that. And then you can sort of test into some riskier sides to try and play the leverage game a little bit more. But Wheaton should always be your foundation investment in that space.
And if somebody would like to learn more about Wheaton and what streams are and how they can benefit their portfolio, where can they go?
Well, the best thing is just to go to the website and you'll have the contact details. We've got a team here that's ready and willing and very capable of answering questions. We get it, this is a unique business model that we created 21 years ago. And so there are a lot of questions about it. It's really taken off. As I said, we only started investing into the gold space about 13 years ago. And so it is a unique way of investing into the precious metal space that isn't really well understood, beyond traditional investors that know the space. And so for someone coming new in, it's wheatonpreciousmetals.com, I believe is and just, look it up and connect up with us. We've got a full team waiting to help you out. And of course, we're also attending a lot of conferences around here of late. And so, stay tuned. We might be coming to a conference near you.
Randy, once again, thank you.
Always a pleasure.